$72,000 a year. That's the number. That is the income. Write it down. Federal income tax, $8,200. State tax, depending on where you live, another $3,600. Social Security and Medicare, $5,500. Rent or mortgage, $1,400 a month. That's $16,800 gone. Car payment, insurance, gas, $680 a month. $8,160. Groceries, utilities, phone, $500 a month. $6,000. Streaming services, subscriptions you forgot about, $180 a month. $2,160. Student loan payment, $320 a month. $3,840. What is left? $17,740 a year. $1,478 a month. That is what you are working with after everything you are legally and practically obligated to pay, out of $72,000. Now, how much of that $1,478 is going to work for you right now? Not saving, not sitting and checking, actually working, in an account that compounds, building something. For most people at this income, the honest answer is somewhere between zero and something that rounds to zero. This video is about why that happens, and exactly how to change it at every level of income, every level of knowledge, starting from wherever you actually are right now. 7 levels, 7 specific actions. By the end, you will know exactly which level you are at and exactly what comes next. Investing is not something you do when you're ready. It's how you become ready. Jordan is 31 years old. He earns $72,000 a year. He has $0 invested. Jordan believes he is almost ready to start. That belief, sincere, reasonable, shared by roughly 57% of Americans under 40, according to a 2024 Bankrate survey, is costing him approximately $1,100 every single month in future wealth he will never recover. Not because he is irresponsible, not because he is spending recklessly. Jordan maxes out his employer benefits. He pays his bills on time. He has a $4,000 emergency fund he built deliberately over 14 months. He reads about the market. He has watched videos. He has a Robinhood account he opened in 2021 and has not touched since. Jordan is not waiting because he is lazy. He is waiting because nobody ever showed him the levels. Level 1. Before you invest $1, know what your money is costing you. Every financial advisor, every personal finance book, every well-meaning parent leads with the same instruction. Pay off your high-interest debt first. But the advice almost always stops there. It tells you what to do. It never tells you why the math makes it non-negotiable, and it never tells you what high interest actually means in a number you can act on. So here's the calculation. The S&P 500 has returned an average of 10.1% annually over the last 30 years, adjusted for inflation closer to 7%. If you are carrying debt at an interest rate higher than 7%, paying that debt off first is the highest guaranteed return available to you. A credit card at 22% interest that you pay off is a guaranteed 22% return. No investment on earth provides that with certainty. The psychological concept at work here is called the sunk cost fallacy. But its lesser-known cousin is what behavioral economists call debt aversion asymmetry, the documented tendency for people to underestimate the drag of existing debt on future compounding. A 2022 paper from the National Bureau of Economic Research found that households consistently underestimated the lifetime cost of carrying revolving credit card debt by an average of 34%. You are not behind because you haven't invested yet. You are behind because you are investing against yourself every month through interest payments that compound in the wrong direction. The action at level 1. List every debt you carry with its exact interest rate. Anything above 7% gets paid aggressively before $1 goes anywhere else. Anything below 7%, mortgage, most student loans, car loans at 4%, you pay the minimum and redirect the rest upward into level 2. The contrast. Jordan has $6,200 in credit card debt at 19.9%. He has been making minimum payments for 3 years. In that time, he has paid $3,400 in interest alone, interest that is gone, producing nothing. A 34-year-old with identical income who cleared that debt in year 1 and redirected $300 a month into the market instead has $11,200 more in net worth today. Same job, same rent, one decision made earlier. Level 2, the account before the investment. Before you pick a stock, pick an account. Nobody says that. It sounds too simple. It is also the reason millions of people pay more tax on their investments than they have to for their entire working lives. The account type determines how your money is taxed. That single variable, account type, can be worth more to your final retirement balance than the actual investments you choose inside it. Show comparison graphic here. Traditional IRA versus Roth IRA versus taxable brokerage. Talk with tax treatment labeled. Here is how each level of investor should think about it. If you are earning under $77,000 as a single filer in 2025, a Roth IRA is almost certainly the right first account. You contribute money after it has been taxed. It grows completely tax-free. You withdraw it in retirement without paying $1 in income tax on the gains. The IRS sets the contribution limit at $7,000 per year in 2025 or $583 a month. If your employer offers a 401k match and you are not capturing the full match, you are declining free money. Not metaphorically. Literally. If your employer matches 4% of your salary and you earn $72,000, that is $2,880 per year being offered to you that you do not have to earn. Decapturing that match before doing anything else produces an immediate 50 to 100% return on that specific dollar depending on your plan. The action at level 2. Open a Roth IRA this week if you do not have one. Set a contribution of $200 a month to start. Not $583, not the maximum, $200, and increase it by $25 every 3 months. Then confirm your 401k contribution captures the full employer match. That is the complete Level 2 move. Nothing more required yet. Level 3. The first investment you will actually make. It is a Saturday morning. You finally open the brokerage account. You click to the trading screen. There are thousands of options. Tickers, funds, ETFs, individual stocks, crypto, options, REITs. You close the app. Not because you are not serious, but because the volume of choice creates a paralysis that feels like caution but is actually avoidance. Psychologists call this choice overload, a phenomenon first formalized by Barry Schwartz at Swarthmore College, who found that increasing the number of available options past a certain threshold reliably reduces the probability that any decision gets made at all. The investment that solves Level 3 is not complicated. It is one fund. A total market index fund, VTSAX if you are at Vanguard, FSKAX at Fidelity. VTI as an ETF gives you exposure to approximately 3,500 U.S. companies in one purchase. The expense ratio on VTI as of 2025 is 0.03%. For every $10,000 you invest, you pay $3 a year in fees. The average actively managed mutual fund charges 0.66%, $66 per year, on the same $10,000. Over 30 years of compounding, but that fee difference on a $50,000 portfolio amounts to roughly $43,000 in additional wealth that you either keep or hand to a fund manager. The action at Level 3. Buy one share of VTI or set up a recurring $50 purchase of FSKAX and let it run. Do not watch it daily. Set a calendar reminder for 90 days from now and look at it then. The first investment is about building the habit of ownership. The size does not matter yet. Level 4. Compound interest is not a metaphor. It is a math problem with a deadline. Ask yourself a direct question. How much would $300 a month, invested starting today, be worth at age 65? At a 7% average annual return, conservative for a diversified index portfolio over 30 years. $300 a month from age 31 to 65 compounds to approximately $454,000. On the same $300 a month starting at age 41. 10 years later, same amount, same return, compounds to $200,000 to $26,000. The difference between starting at 31 and starting at 41 is not $36,000, it is $228,000. A decade of delay on a $300 monthly contribution costs more than 6 years of those contributions in lost future value. Show compound growth graph here. 2 lines, same contribution, 10-year difference in start date. A 2023 study by Vanguard Center for Investor Research tracked 5 million account holders over 20 years and found that the single variable most predictive of retirement security was not contribution rate, not investment selection, not income level. It was the age at which the investor made their first contribution. Pre-investors who started before age 35 ended with median balances 2.4 times higher than those who started between 35 and 45, even when the late starters contributed more per paycheck to compensate. You cannot make up lost time with larger contributions. The math is not designed to allow it. The action at level 4. Run your own compound interest calculation right now. Not a hypothetical, your actual age, your actual contribution capacity, your actual retirement target. Use any free compound interest calculator. Put in the real numbers. Then add 10 years to your starting age and see what the delay costs. That number is the cost of waiting. Write it down. Keep it somewhere visible. Level 5. Diversification is not owning more things. It is owning things that move differently. Here is what most new investors do. They buy 5 different tech stocks and tell themselves they are diversified. Amazon, Apple, Google, Nvidia, Microsoft. Those 5 companies move in the same direction under the same macroeconomic conditions. When interest rates rise, all 5 fall. When the tech sector corrects, all 5 correct. You do not have 5 different bets. You have one bet, 5 times. Actual diversification means your portfolio contains assets that respond differently to the same economic event. U.S. stocks and international stocks. Stocks and bonds. Growth assets and dividend-producing assets. Real estate investment trusts. Each of these asset classes has periods of outperformance and underperformance that do not perfectly correlate with each other. The research on this is unambiguous. A 2024 analysis from Morningstar found that a portfolio allocated 60% to U.S. equities, 20% to international equities, and 20% to bonds produced nearly identical returns to a 100% U.S. stock portfolio over the prior 30 years, with 31% lower volatility. Same destination, significantly smoother ride. And critically, investors with smoother portfolios were statistically less likely to panic sell during corrections, which is the most destructive thing a retail investor can do. The action at level 5. If you are under 40 with a long time horizon, a simple 2-fund portfolio, 80% total U.S. market, 20% total international, covers the most important diversification move available to you without requiring any active management. Full target date retirement funds do this automatically if you prefer not to manage allocation yourself. Stop for a second. Most people stop watching at this point. Not because the content gets boring, because it starts to get specific enough to require an honest look at an actual number they have been avoiding. If that is happening right now, if something in the last 5 minutes made you quietly aware of a decision you have been not making, that awareness is not an accusation. It is information, and uncomfortable information is the only kind that precedes a structural change. The second half of this video is where the levels get harder. Not because the concepts are more complex, because they require you to think about money not as something you manage month to month, but as something that is either working for you while you sleep or sitting still while everything around it grows. That is a different relationship with money than most people were taught to have. Level 6. Tax efficiency is not an advanced strategy, it is a foundational one. Ask yourself honestly, do you know right now, what your effective tax rate is on your investments. Not your income tax rate, your investment tax rate. And is that belief based on a calculation or a feeling that you've been handling things correctly? If you are holding investments in a taxable brokerage account and selling them within 12 months of purchase, you are paying ordinary income tax rates on those gains, anywhere from 22 to 37%, depending on your bracket. If you hold the same investment for more than 12 months before selling, you pay long-term capital gains rates, 0%, 15%, or 20%, depending on income. That rate difference on the same investment, the same gain, the same dollar, is the single most controllable variable in your investment return after account type. A $10,000 gain taxed at 24% leaves you $7,600. The same $10,000 gain taxed at 15% leaves you $8,500. You did nothing differently. You just waited. The action at level 6. Before you sell any investment, check the purchase date. If you are within a few weeks of the 1-year mark, wait. The tax savings in most cases are larger than any short-term price movement you are trying to capture. This is a one-time calendar check that costs you nothing. Level 7. The shift from accumulation to architecture. You are sitting across from someone who just asked where you put your money. You used to answer with something vague. A little here, a little there. I'm figuring it out. Level 7 is when that answer changes. Not because you have more money, because you understand what each account is doing and why. At level 7, your financial life has an architecture. A tax-advantaged retirement account capturing the employer match, a Roth IRA fully funded each year, a taxable brokerage account for goals before retirement age, an emergency fund in a high-yield savings account earning 4.5% instead of 0.01%. Each dollar has a job. Each account has a purpose. That the psychological concept that blocks most people from reaching this level is what Harvard economist David Laibson identified as present bias, the measurable human tendency to overweight immediate rewards and underweight future ones, even when we know the future reward is larger. In a landmark study published in the Quarterly Journal of Economics, Laibson showed that people behave as though their future selves are strangers, people they theoretically care about but do not make concrete sacrifices for today. The fix for present bias is not willpower. It is automation. Move the money before you can spend it. Set the contribution before you see the paycheck. Create a system where the future version of you has already been paid before the present version makes a single decision. Turn the action at level 7. Map your current accounts on a piece of paper. Label each one. Name what it is for. Find the gap. The account you do not have, but should. The contribution you have not increased. The automation you have been meaning to set up. Then set it up today. Not this week. Today. Ask yourself 2 things, honestly. Do you believe you are investing correctly right now? And is that belief based on a specific number you can point to? A contribution rate, an account type, an allocation? Or is it based on the feeling that you are probably doing something right because you have thought about it enough times? Neither answer makes you a bad investor. One of them means you already know what you are going to do before this video ends. Here is the pattern behind every level in this video. It is not a behavior problem. It is an information problem. Every person who has not started investing, or who started but has not moved past level 2 or 3, made that decision with incomplete data. They were told to be careful. They were told to wait until they understood. They were told that doing it wrong was worse than not doing it at all. None of that is true, and none of it was told to them by someone who had done the math. The information gap is the architecture that produces the outcome. Fix the information. The behavior follows. Jordan is still 31. Same job. Same $72,000. Same $1,478 a month after obligations. 2 years ago, he stopped waiting until he was ready. He opened a Roth IRA on a Tuesday afternoon in the time it took to eat lunch. He set a $200 monthly contribution to FSKAX. He captured his full employer match on his 401k, $2,880 a year. He had been declining without knowing it. He paid off the credit card in 11 months by redirecting $520 a month at it. Today, his investment accounts total $14,300. That number is not impressive. The number is not the point. The point is the trajectory. At his current contribution rate, with compound growth at 7%, Jordan's accounts cross $100,000 at age 39. They cross $300,000 at age 48. They cross $700,000 at age 58 without a single raise, without a single windfall, without a single market timing decision. Jordan did not get smarter about money. He stopped waiting to be. It is a Thursday at 2:47 in the afternoon. Jordan is in line at a grocery store. His phone buzzes. It is an automatic investment confirmation. $200 moved from checking to his Roth IRA, the way it does every month on the 15th. He does not feel proud. He does not feel like he accomplished something. He barely registers it. That is the part that cannot be explained until you are inside it. The absence of the not. The specific quiet of not checking a balance with dread. His car payment is due Friday. He knows that. It is not a wait. It is a calendar item. There is $14,300 in an account working right now while he is deciding between two types of pasta. He did not put it there all at once. He did not understand everything before he started. He is not monitoring it. It is just there, doing the thing money does when you let it sit long enough. The pasta costs $3.49. He picks the one he likes. That is it. That is the whole scene. Nothing dramatic. It just doesn't cost him anything to be alive today. And that is what this is actually about.